Welcome to this comprehensive guide on cryptocurrency taxes and reporting requirements. Understanding how to properly report your crypto transactions is essential for staying compliant with tax authorities and avoiding potential penalties. Let's explore everything you need to know about crypto tax obligations. First, let's identify which crypto activities trigger taxable events. Trading and selling cryptocurrency for fiat currency or other assets creates a taxable event. Receiving cryptocurrency as payment for goods or services counts as taxable income. Mining rewards and staking rewards are also taxable when you receive them. Even converting one cryptocurrency to another, like trading Bitcoin for Ethereum, is considered a taxable transaction. Cryptocurrency is treated as property for tax purposes, which means capital gains rules apply. If you hold crypto for 1 year or less before selling, any profits are taxed as short-term capital gains at your ordinary income tax rate. However, if you hold for more than 1 year, you qualify for long-term capital gains rates of 0%, 15%, or 20%, depending on your total income level. The longer holding period can result in significant tax savings. Certain crypto activities generate ordinary income rather than capital gains. If you receive salary or wages paid in cryptocurrency, this is taxable as regular employment income at the time you receive it. Mining rewards are taxable as income based on the fair market value when you successfully mine the coins. Staking rewards follow the same principle and are taxed when received. Airdrops and hard fork rewards are also generally treated as ordinary income when you gain control of the new tokens. Accurate record keeping is absolutely critical for crypto tax reporting. You must document the exact date and time of every transaction. Record the purchase price and sale price for each crypto asset to establish your cost basis. When you receive cryptocurrency, note the fair market value in dollars at that moment. Keep detailed records of which exchanges and wallet addresses were involved in each transaction. These records will be essential for calculating your tax liability and defending your reporting if questioned. Calculating your capital gain or loss is straightforward once you have good records. The formula is gain or loss equals sale price minus cost basis. Let's walk through an example. Suppose you bought one Bitcoin at $30,000. Later, you sold that Bitcoin for $45,000. Your capital gain would be $15,000, which is the difference between your sale price and your original cost basis. This gain would then be taxed according to whether it was short-term or long-term. When you own multiple units of the same cryptocurrency purchased at different prices, you need to choose a cost basis method. The first-in first-out method, or FIFO, assumes you sell the oldest coins first. This is the default method and simplest to track. Alternatively, the specific identification method allows you to designate exactly which coins you're selling. This gives you more control to optimize your tax outcome, but requires meticulous record keeping to identify specific units. Choose your method carefully and apply it consistently. Several tax forms are needed to report cryptocurrency transactions. Form 8949 is where you list each individual sale or exchange with its gain or loss. Schedule D summarizes your total capital gains and losses from Form 8949. If you received crypto as income from sources like airdrops or rewards, you'll report this on Schedule 1 as additional income. For those running a mining operation or crypto business, Schedule C is used to report business income and expenses. Make sure to complete all applicable forms accurately. Not every crypto activity creates a tax obligation. Buying cryptocurrency with regular fiat currency like dollars is not a taxable event. Simply holding crypto in your wallet, regardless of how much its value increases, triggers no tax until you sell or use it. Transferring cryptocurrency between wallets that you own is not taxable since you still control the asset. Gifting cryptocurrency is generally not taxable for the giver, up to the annual gift exclusion limit. Understanding what doesn't trigger taxes helps you plan transactions more strategically. Following best practices will make tax compliance much easier. Track every single transaction as it happens throughout the year rather than scrambling at tax time. Consider using specialized crypto tax software that automatically imports transactions from exchanges and calculates your gains and losses. For complex situations involving DeFi, NFTs, or international exchanges, consult a tax professional with cryptocurrency expertise. Finally, always file your tax return on time to avoid penalties and interest charges. Proper planning and documentation will help you stay compliant and minimize your tax burden legally.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.